in this segment, we'll be looking at annuities. So going over, not on this board, but I'll walk you through it, going over what they are, how they work, advantages, disadvantages, the different types, and how they can be funded. All right, so starting off with what are annuities? So what are annuities is that they are providing a sense of security. They give a regular stream of income to the annuitant, the person who's getting the payment. So if someone has, let's say, a large sum of money and they want to save that money for their maybe retirement years, at that point they want to get it kind of like a salary, like a regular stream of income, then you can buy an annuity. Now, how it works with buying an annuity is you would take that money, and life insurance companies are the only ones that would be issuing the annuity, and you would give it to the life insurance company and they would pay you whenever that contract is decided, a certain amount from that every month. It's usually a monthly payment of principal plus an interest as well, right? So you would make that, let's say you have 100,000, 500,000, make that last over some time, and you're getting it in small chunks, like a regular stream of income. All right. Now, with annuities, you can have a payout annuity, or you could have an accumulation annuity. Accumulation annuity now is when you're making deposits, so you don't have a huge lump sum, you're making small deposits and it's not paying right now, right? So eventually it will be a payout annuity, but at the moment you're just accumulating the funds, right? So it's an accumulation annuity. And payout annuity, just as it sounds, is that it's actually making payments to you. Now with the payout annuity, it could be immediate. That means the payments are starting right away. Or deferred. That means you don't need the payments to start right away. Maybe you need them in 5 years, in 10 years, in 20 years, but you're deferring them for some time, right? So don't not need it right away. So a lot of sort of flexibility as well, a lot of sort of ways you can structure it based on your own individual needs and whatever is your own desires. There's a lot of ways this can be structured. It could be a life annuity, so it would pay for the rest of the life, or it can be a term annuity that you only need it for a certain amount of time. What's important to remember with an annuity is that you cannot stop the payment once they've started. So once those payments have started, you can't change your mind at that point, and now it's going to kind of go on, right? So that's important to remember. And of course, how much you get is dependent on, of course, the interest rate that you get when you are purchasing your annuity, and that interest rate is locked in. And also a lot of other factors such as age, if it's life or if it's term. So if somebody is older, typically they would get a higher payment. It's like the opposite of life insurance, right? Because they want to pay that money back to you while the person is alive. So if somebody's purchasing the annuity when they're older, chances are they would get a higher payment versus someone who is younger, because they want to get that money back before the person passes away. And same thing, if it's a life annuity, they have to stretch out that money. So let's say if it's $500,000, they have to stretch that out for the rest of the person's life, versus if they only need it for 5 years and then like their pension is going to start or something else, then you would get higher payments. So your payments depend on a lot of factors, right? So interest rate, age, how long the payments are going for, it can make the payments larger or smaller based on all of those factors, right? But you can definitely make it life or term if somebody only needs it for a certain amount of time, or if they want it for the rest of their life. Now, when we're looking at advantages for annuities, there's a couple of different advantages we can see. First, and the most obvious one, is that it gives income security. So what that means is that you're able to sort of customize that income based on your needs. So it can give a lifetime income, right? So if somebody's retiring or retired, it's giving another stream of income, which might be really helpful to them at that age when they're not actually earning any money. So lifetime income. It can give spousal income, right? So when we look at the different types, you'll see that you're able to combine and make it into a joint product with your spouse. So it's able to provide the surviving spouse with some income, if one of the spouses passes away. And it can give temporary income. So if it's a term annuity, you can structure it in a way that it's able to give temporary income for the amount of time that is needed, right? So again, very, very sort of flexible in that way. It is creditor protection. So that's another sort of great advantage and great feature that we see with annuities as well, is that if there's somebody who is self-employed or business owners, and for those people, it's, the creditor protection is something that's a great feature to them. So here again, you are able to sort of, name those specific beneficiaries, and that way it does provide that protection element as well. So great for those individuals who are looking for something with that type of a purpose. And when we're looking at now the different types, so those are your key advantages that we can see with annuities and why people like annuities, such a popular product as well. And the different types, so we've already gone over this, and I'm just going to go over it again. It's a short chapter in the book, but I want to make sure you guys are very clear of what they are. So again, you can make it into a payout or an accumulation annuity. So payout would be that it's paying you either right now or later on. An accumulation is when you're just getting your funds together. Single life, so it's just on the life of one person, or joint. So again, if it's a spouse, a couple that you're dealing with, you can make a joint life, right? So it would be uncovering both spouses, and that way you have the spousal income also covered. It can be term or it can be life. So again, you can make it life annuity or term annuity. Now, another thing to remember with the types is if someone has a shortened life, that's considered to be an impaired annuity, and you do need a medical certification or something to show that there is, a reason, a logical medical reason why that person has that shortened life. So if they have some sort of disease or illness, then they would be able to get higher payment and a lower premium, right? So because the idea is the insurance company says, okay, well, this person has a shortened life than the average person their age, we want to make sure we give those payments back to them and give those funds back. So you do need a medical certificate to sort of prove that. But if that is the case, then the person is able to get that impaired annuity where they're able to get higher payments rather than someone else of their own sort of age and bracket, right? Now, how do we fund the annuity? How is it funded? So like I said, you can do a lump sum payment. So if someone has, maybe they've inherited some funds from a parent or from grandparent there, and they can purchase an annuity. So you can do a lump sum. What if they don't have any funds that they've inherited? They can also transfer from a registered account as well. So if they have money that's sitting there in their, let's say, RRSP or any other sort of registered account, they can definitely transfer RRIF, any of those accounts. So they would be able to just transfer those funds over, and that can be used to pay out the annuity. Or they can make payments. So if you don't have any sort of lump sum, sitting somewhere in some account even, you can make payments. So start when the person is young, early, and use an accumulation annuity. So they would be making payments every time. And once they have gathered up enough funds, maybe they wanted to start when they're retired, then that can be used, right? So different ways that it can be funded. And again, when we're looking at taxation, it depends on how it's funded. So if it's used from a registered account, it is going to be taxed because those are pre-tax dollars. So you will be paying a tax on that. If it's from your own after-tax payments, then it's not going to be taxed, right? So there are those tax sort of allocations on that. Depending on how it's funded, the tax rules will change. All right, and now finishing off with before we finish off with limitations, the income. So the income from the annuity, it could be, like we said, immediate, or it could be deferred. It could be level, or you can index it. So whenever we say level, always think of like a steady sort of a level. So it'll be the same whenever you have a level payment. It's always the same. So if you're getting, let's say, $1,800 a month, it'll always be $1,800 a month. Or it can be indexed. If somebody is worried about the cost of the purchasing power and inflation and all of that, they can index that annuity as well. So it's not always $1,800. It will increase by a certain percentage up to a cap, but it will increase, right? So you can sort of play around with how you want that income to be received. All right, and now finishing off with the limitations for annuities. So we talked about a lot here on this one board, finishing off with limitations. So one of the biggest limitations or disadvantages of annuities is an interest rate or inflation risk. So like I said, once you get a certain interest, you're locked in at that interest rate. If that interest rate changes in a month, in a couple of months, too bad, right? So that's one of the biggest disadvantages that we see, is that that interest rate might not be that great. When you purchase your annuity, you may not get a good interest rate. What if it's so low that the cost of inflation is higher, and you know, you're kind of losing the value of your money? So that is a risk, that you are locking in that interest rate, so that it can it might be good or it might be bad. So that's a potential risk we see. There is a risk of loss of capital as well, right? So we're definitely seeing that as one of the risks as well. And what do we mean when we say that as loss of capital? So when you are purchasing an annuity, it does not have any sort of guarantee periods, right? So unlike seg funds, you do have a little bit more guarantee and peace of mind. So there's no guarantee in terms of the of your capital. So if the annuitant dies and the contract ends, and let's say that, you know, the death occurred just after the payments began, most of that capital would be retained by the insurance company. So that's definitely a disadvantage that we can see. You can name a beneficiary to the contract, but in case if that's not there, then that risk is there, right? So we did say that you can name a beneficiary, and then that will be kind of offsetting that risk, but that is something that's there. And there are restrictions on withdrawal. So like we said, that once the payments start, you can't stop them. So unlike seg funds, where you are able to take money out, but you have to pay penalties, here you don't even have that option. So it is kind of locked in once the payments have started. So very little sort of flexibility, very little liquidity, and it is something that, you know, it cannot, like if you've locked in, let's say $500,000 and your payments have started, can't really access that money, right? You probably have to go through a whole process. So that is one of the problems or the limitations of it, is that it is more of a illiquid sort of investment. You can't take it back out. All right, so that's how annuities work. You can definitely refer back to chapter 3 if you need to kind of brush up on it or look into a little bit more. But I think we've covered a lot in terms of what they are, types of annuities, advantages and disadvantages. So join back in our next segment. Now we'll be looking at some of the group plans that are available, some of the government plans that are available for retirement and for funding different types of needs as well. So we'll start from there. So thank you so much, and I'll see you in the next segment.